Hi everybody. In the next series of video lectures, we'll discuss accounting changes and error corrections. Illustration 20-1 in your textbook shows the types of accounting changes. This is an important illustration and should be flagged for future reference. As shown in the illustration, accounting changes fall into one of three categories: change in accounting principle, change in accounting estimate, or change in reporting entity. Let's look at those a little more closely. A change in accounting principle is a change from one generally accepted accounting principle to another, and examples might include the company has adopted a new accounting standard, or the company has decided to change methods of inventory costing, or maybe the company changes from the cost method to the equity method, or vice versa. A change in accounting estimate is a revision of an estimate because of new information or a new experience of the company. Examples of those might include a change in depreciation methods, change in the estimated useful life of a depreciable asset, change in estimate of residual value of depreciable assets, which is also sometimes referred to as salvage value, a change in the estimate of periods benefited by an intangible asset, and maybe a change in actuarial estimates pertaining to a pension plan. A change in reporting entity happens when we change from reporting as one type of entity to another type of entity. And examples usually include some method of consolidation. Perhaps we have a subsidiary that we are going to consolidate in the current year's financial statements that were not previously included in consolidated financial statements of prior years. Or maybe all along we have been not consolidating our financial statements, but issuing financial statements for each individual company. And now in this year, we have changed to consolidated reporting entity instead of the individual entities. The correction of an error is another adjustment sometimes made to financial statements that is not actually an accounting change, but it is accounted for similarly. Errors occur when transactions are either recorded incorrectly or not recorded at all. There are three approaches to reporting accounting changes and error corrections, and which one is used depends upon the situation. When using the retroactive approach, financial statements issued in previous years are revised for all years shown in the comparative financial statements. The statements are made to appear as if the newly adopted accounting method had been applied all along, or that the error had never occurred. Then a journal entry is created to adjust all account balances affected. The modified retrospective approach will apply a new standard only to the current period and will adjust the retained earnings at the beginning of the year for the cumulative effect. The prospective approach shows the effects of changes reflected in the financial statements of only the current and future years. Now let's look at each type of accounting change one at a time, focusing on the selective application of these approaches. We'll talk about a change in accounting principle briefly in this video lecture, and then we'll go into applying the retrospective approach in making the change in an accounting principle in the next video lecture. But just in general, accounting is not an exact science. Professional judgment is required to apply a set of principles, concepts, and objectives to specific sets of circumstances. This means choices must be made. In your study of accounting to date, you've encountered many areas where choices are necessary. For example, management must choose whether to use accelerated or straight-line depreciation. They must decide if FIFO, LIFO, or average cost is the most appropriate method to measure inventories. And they need to decide if a new accounting standard should be adopted early, or should the company wait until that new standard is mandatory. These are but a few of the accounting choices management makes. You also probably recall from your accounting study that financial statements should be comparable from year to year. That's one of the goals of generally accepted accounting principles, is to make financial statements comparable from year to year. Therefore, accounting choices, once made, should be consistently followed from year to year. This doesn't mean, however, that methods can never be changed. Changing circumstances might make a new method more appropriate. Here's a question for you. Which of the following is not a change in accounting principle? A change from LIFO to the average cost inventory costing method. Or B, a change in the useful life of a depreciable asset. Or C, a change to implement a new FASB accounting standard. Or D, a change from the equity method to the cost method to value investments in subsidiaries. Did you select number B? B is the correct answer. A change in the useful life of a depreciable asset is a change in accounting estimate, not a change in accounting principle. Well, that's all for this video. In the next video, we'll talk about the application of the retrospective approach when an accounting principle changes. See you next time.